Welcome to Iron Financial, the place we come to forge stronger portfolios by cutting right through the market noise. Today, we're putting Kite Realty Group, that's ticker KRG, squarely on the anvil. They just dropped their Q4 2025 earnings, and look, the numbers are absolutely blasting through consensus estimates. But we're not here just for the fireworks, you know that. We are here to run a full-on structural stress test. See, management is telling us a story of transformation, a story about building a fortress designed to last for the next decade. Our job is to find out if that foundation is solid rock or if it's just built on sand. All right, let's get to work.
Okay, let's just jump right into this. The number that has everyone's head spinning is this one, an 852% earnings per share beat. Yeah, you heard me right. KRG reported EPS of 84 cents when the street was barely looking for 9 cents. That's not a beat. That's a complete and total demolition. Now, this is the number that grabs all the headlines, for sure, but it's also the number that demands the most scrutiny from us. Is this real, sustainable, operational power we're seeing, or is it just a one-time sugar high from selling off a bunch of assets? That's the core question we absolutely have to answer today.
And here you have it, the official narrative, coming straight from the top. The CEO, John Kitt, is framing 2025 not just as some lucky great year, but as the pivotal year in a much longer multi-year transformation. He's using words like focus, precision, critical steps. I mean, this is the bull case right here in a nutshell. The argument is that management didn't just luck into a good quarter, they meticulously engineered it. They are actively, and I mean actively, tearing down and rebuilding this company from the ground up. This quote really sets the stage for everything else we're going to talk about. They're telling us they did the heavy lifting. So, let's see the evidence.
All right, let's get down into the engine room. These are the core operational metrics, the numbers that really show you the day-to-day health of the business. First up, core funds from operations, FFO. It's up 3.5% for the year. Now, for a REIT, FFO is everything. It's the lifeblood. It's the real cash flow that funds the dividend you get paid. Seeing that grow is a fundamental sign of strength. Then you've got same property net operating income, up 2.9%. This tells us that the core assets, the properties they've held onto for a while, are just generating more cash than they did last year. Simple. But here's the real power metric for me. Blended leasing spreads, a massive 13.8%. What does that mean? It means on all the new and renewal leases they signed, they're jacking up rents by nearly 14%. That, my friends, is pricing power. And with their key anchor tenants locked in at a 96.7% lease rate, the foundation here looks incredibly solid. On the surface, this is a picture of a very, very healthy operator.
And this is the point that management is just hammering home again and again. You heard it on the earnings call. John Kite said it himself. This isn't about the next 4 or 5 quarters, it's about the next 4 or 5 years. They're intentionally taking some short-term hits on the chin to execute a much bigger long-term vision. The whole goal is to build a portfolio with a better growth profile, something more durable, something that can weather the economic cycles that are inevitably coming. It's a classic case of skating to where the puck is going, not where it is right now. They are proactively reshaping the entire company for the future of retail, and they're basically asking investors, trust the process. And this slide right here, this lays out the battle plan perfectly. This isn't just redecorating the house, it's a full-on gut renovation down to the studs. On the left, you see the past. These bloated power centers, totally vulnerable to the slightest economic tremor, anchored by retailers that were basically on life support. That was their Achilles heel. But on the right, you see the future. Fortress-like, grocery-anchored centers located in high-growth Sunbelt markets. They're literally swapping out dying discount stores for premium brands that people love, like Whole Foods and Trader Joe's. This isn't just a pivot, it's a flight to quality. They're building a portfolio that is designed to thrive, not just barely survive. And this just brilliantly illustrates that management isn't just talking a big game, they are acting. These numbers, these represent the real sweat and steel of their transformation. They didn't just trim the portfolio, they took a chainsaw to it, selling off over $600 million in assets, mostly those older, weaker power centers. And in doing so, they surgically removed 21 of those watch list anchor tenants. That is a major, major de-risking move. But they didn't just sell. They reallocated that capital with incredible discipline. They bought back $300 million of their own stock. That's a full 6% of the company, at what they calculate to be a 9% FFO yield. That is a huge arbitrage when you're selling assets at much lower yields. And while all this was happening, the leasing team was just on fire, signing nearly 5 million square feet of space. This is a company in serious motion, aggressively executing its plan on all fronts. So, okay, what's the result of all this heavy lifting? Well, it's right here in this chart. We're looking at embedded rent growth.
Basically, this is the contractually obligated rent increases that are already baked into their existing leases. It's future growth you can count on. In less than a year, they've boosted this number from 1.56% all the way up to 1.80%. Now I know what you're thinking. 24 basis points, that might not sound like a whole lot. But for a multi-billion-dollar real estate portfolio, that is a massive increase in future, predictable revenue. On the earnings call, management said their goal is to get this number up to 2%, and they are closing in fast. This is the tangible proof that their new blueprint, their focus on higher quality assets, is actually working. It's creating a stronger, more predictable, and higher growth income stream for years to come. Whoa, hold on a minute there. That is a very, very compelling story. I'll give you that. Management is painting a masterpiece. But my job is to look for the brushstrokes, to see if that fresh coat of paint is maybe hiding a few cracks in the wall. A lot of these big positive numbers, especially that mind-boggling 852% EPS beat, they're juiced by gains on selling over $600 million worth of property. That's not recurring operational strength. That's selling the family silver. So we have to ask the question, is this sustainable growth we're looking at, or is it a financial mirage created by a one-time portfolio shuffle? Let's peel back some of these layers and really apply some pressure. Okay, so the analyst pointed to that blended leasing spread of 13.8% as this incredible sign of strength. But when you break that number down, the picture gets a lot more complicated. Look at this. For brand new leases, yes, absolutely, they are crushing it. They're getting nearly 22% rent hikes in Q4. That's impressive, no doubt. Even on renewals, where they have some negotiating power, they're getting a strong 14.5%. But, and this is a big but, look at that bottom line. On option renewals, where the tenant holds all the power and has a pre-negotiated rate, that growth drops off a cliff to just 6.2%. And you have to remember, a really significant portion of their portfolio rolls over on these exact options. So this suggests that while their pricing power on the margins is strong, a big chunk of their core income stream is actually growing at a much, much slower pace. And this right here, this is the central question for me. This is the disconnect that's been bugging me. On one hand, you have management on their earnings call boasting about these incredible 20+% rent increases on new leases. That is the bull story. But then you look at the reality check for a shareholder, the dividend, the actual cash that hits your account. For the first quarter of 2026, they raised that dividend by only 7.4%. So let's just ask the hard question. If you are signing new tenants at 22% hikes, but you can only afford to raise the shareholder payout by 7.4%, where in the world is that extra cash flow going? Is it being eaten up by capital expenditures for all these new redevelopments? Is it being held back to pay down debt early? Or, and this is a real test, is the overall cash flow of the company simply not as strong as that headline leasing number makes it sound? The story and the payout, they just don't seem to line up perfectly for me.
And here's another pressure point. While that EPS number was a massive headline-grabbing beat, it is absolutely crucial to look at the top line, revenue. For the fourth quarter, Kite Realty missed their revenue forecasts by 3.08%. In fact, total revenue was actually down year over year. It went from about $212 million in Q4 of 24 to $205 million in Q4 of 25. This right here is the inherent danger of a shrink-to-grow strategy. When you sell off $622 million worth of income-producing assets, it creates a big hole in your revenue stream. The question is whether the growth from the new strategy can fill that hole fast enough. And right now, the top line is eroding. That's a red flag we just can't ignore.
And it's not like I'm making this up. Management admits this themselves deep in the earnings call. This entire strategy, all this heavy lifting, is creating a direct, quantifiable drag on next year's earnings. Their own guidance bridge shows a 2-cent drag on 2026 FFO, specifically because of the timing difference between when they sold properties and when they can actually put that cash back to work in new ones. So while they're promising long-term strength and durability, shareholders are feeling the financial pain right now, today, in the guidance for the upcoming year. The future might be bright, but the present is diluted, and that's the trade-off you're making. Okay, now let's move away from the income statement and get to the very foundation of the company, the balance sheet. I mean, a great collection of shiny new properties is completely worthless if the debt structure underneath it is fragile. And right now, KRG is heading straight for a pretty significant test. They have a wall of debt coming due, and in a market where interest rates are, let's say, uncertain, refinancing is not the simple rubber stamp exercise it used to be. The big question is, can this foundation, new or old, handle the pressure that is definitely coming its way? Just look at this. This is what we call the debt wall. In 2026 alone, KRG has over $400 million in debt maturing.
The year after that, 2027, another $283 million comes due. You add that up, that's nearly $700 million that needs to be refinanced or paid back in the next 24 months. Now, if interest rates are higher when these notes come due, their interest expense could jump significantly, and that would put direct pressure on that FFO growth we were just talking about. A company that's in the middle of a complex transformation is also a company that desperately needs a stable financial base. This is a major test of their financial discipline and their access to the capital markets. It's a significant overhang, for sure.
That's a fair point. I mean, that debt wall is real, and any prudent investor should absolutely be looking at it. But this is exactly why management has been so aggressive in strengthening their financial position before hitting this wall. The skeptic sees a risk, but I see a calculated test that the company has spent years preparing for. This is not a surprise storm that's going to catch them off guard. This is a planned maneuver, and they have built the ship specifically to handle it. Let's look at the defensive measures they've already put in place.
These right here, these are the pillars of what I would call their fortress balance sheet. First, let's talk leverage. Their net debt to EBITDA is only 4.9 times. That is incredibly conservative. It's not just low, it's below their own stated target range. This gives them a massive cushion. Second, liquidity. They have over $1 billion in available capacity. $1 billion. That's more than enough to pay off that entire 2-year debt wall in cash if they absolutely had to. Third, look at their debt profile. 84% of their existing debt is fixed rate. This insulates their current cash flow from any further rate hikes. And finally, asset quality. Nearly 90% of their income comes from unencumbered assets. That means properties with no mortgage on them. This gives them immense flexibility to go out and secure new financing if they need it. So yeah, the debt wall is there, but they have the low leverage, they have the cash, and they have the collateral to manage it effectively.
And look, you don't have to just take my word for it. Look at the third-party validation from the credit rating agencies. These are the experts whose entire job is to stress test balance sheets all day long. S&P gives them a BBB with a stable outlook. Moody's a Baa2, also stable. And check out Fitch, BBB with a positive outlook. You do not get these kinds of investment-grade ratings if your foundation is cracked. It just doesn't happen. These agencies have looked at the exact same debt maturity schedule, the same portfolio transformation, and the same market risks that we have, and they've all concluded that this is a stable, well-managed company with a strong financial footing. This is the market stamp of approval on their balance sheet, plain and simple.
Okay, we've run the stress test, we've heard the bull case from management, and we have listened to the skeptics' probing questions. We've examined the operational numbers, the strategic transformation, and the all-important balance sheet. So let's bring it all together for the final verdict. What have we actually built here? Is KRG a fortress in the making, or is it a house of cards just waiting for the next gust of wind to come along? The bull case is really compelling. It's a story all about execution. Management laid out a crystal-clear plan to pivot towards higher quality, higher growth assets, and the numbers show they are doing exactly that. Operationally, they have serious momentum, with strong leasing spreads that prove their properties are in high demand. They're actively de-risking the portfolio by cutting loose weaker tenants and selling off the exact asset class, those power centers, that worries the market the most. And they've supported this entire operation with a fortress balance sheet, keeping leverage low and liquidity high. And crucially, they've shown amazing discipline in their capital allocation, using the proceeds from asset sales to buy back their own stock at a significant discount, which creates clear, tangible value for shareholders.
But the bear case raises valid concerns that you really can't just dismiss. There are clear pressure points here. That disconnect between the massive rent hikes on new leases and the pretty modest 7.4% dividend increase, that's a major one. It suggests the underlying cash flow available to shareholders isn't as robust as the headlines make it sound. Top-line revenue is down, and management even admits their strategy is dilutive to FFO in the short term. That debt wall, while it looks manageable, is still a hurdle that has to be cleared in an uncertain rate environment. And let's be honest, executing a shrink-to-grow strategy is notoriously difficult. The timing has to be perfect. Any misstep can destroy value instead of creating it. The risks here are very real. So, here is the Iron Financial verdict. After analyzing all the evidence, we see the pressure points, but we don't see them as foundational cracks. The dilution, the revenue dip, the disconnect between spreads and the dividend, these are not signs of a business in distress. They are the calculated, temporary, and completely transparent side effects of a massive, deliberate, structural renovation. KRG isn't a building that's crumbling under market pressure. It's a building that has been intentionally stripped down to its steel beams so it can be rebuilt stronger than before. This is a structure under a deliberate, self-imposed stress test. Our final verdict is clear. Kite Realty is an opportunity.
The short-term pain is a calculated cost for long-term durability. Management has proven its ability to execute a very complex strategy with precision, selling off low-growth assets and redeploying that capital into higher-growth properties and accretive share buybacks. The Fortress balance sheet is more than capable of handling the upcoming debt maturities. The market, it seems to us, is overly focused on the short-term dilution while underappreciating the long-term growth profile and the portfolio quality that's being built right now. They are trading today's optics for tomorrow's performance. In our view, that's not a crack in the foundation. That's the blueprint for building value.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.